Hey everyone, welcome back to Corporate Decoder, where we decode the complex world of corporate finances, and today we're diving deep into a big annual report from CVB Financial Corp. Known as CVBFF, get ready because this 10K filing for the year ended the 31st of December 2025 is packed with numbers, risks, and even a pending merger that could shake things up. Make sure you are subscribed because we break down these massive documents so you don't have to, and join our Discord community linked in the description below where we chat all things corporate finance. This is the big one, the annual report that gives us a comprehensive look at a company's performance over the entire year. For CVB Financial Corp, this filing covers their journey through the 31st of December 2025 a year. That was quite eventful for them. Now, CVB Inc. operates as a bank holding company with its main asset being Citizens Business Bank, or CBB, as of the end of 2025. Their consolidated assets crossed a significant milestone, hitting $15.63 billion. That is a ton of money, and it shows they're a pretty substantial player in the banking world, especially in California where they do most of their business. They operate with 5 core values which they say guide their business: financial strength, superior people, customer, focused, cost-effective operation, and having fun. It sounds good on paper, but let's see if the numbers back it up. When we look at their human capital, they had 1079 associates at the end of 2025, a slight dip from the previous year. This indicates a very stable workforce. Now let's get to the juicy stuff, the risks. In the financial world, credit risk is always a big one. It is the risk that borrowers won't pay back their loans. CVB states their allowance for credit losses might not be enough to cover actual losses, a classic warning sign. They might have to set aside more money for loan losses, which would hurt their profits. Interestingly, they highlight specific risks in their dairy, livestock, and agribusiness lending. Apparently, these loans have some unique challenges, and a significant portion of their loan portfolio is secured by real estate in California. So if the California real estate market takes a tumble, they could be in for some trouble. Liquidity is king in banking, and they acknowledge that liquidity risk could seriously impair their ability to operate. They've seen negative developments affecting the banking industry, which could impact them too. This refers to the banking turmoil that happened in 2023, where some regional banks faced serious liquidity issues and customers got nervous. While CVB has access to borrowing from the Federal Reserve and other banks, there is no guarantee that confidence will fully return or that these sources will always be available. This is a big one. They are in the middle of a pending merger with Heritage Commerce Corp, which is an all-stock deal. The script really hammers home the risks here. Failure to complete the merger could have negative consequences. Combining two companies is always tricky, and it might be more difficult, costly, or time-consuming than expected. They also worry about retaining key employees after the merger and the possibility that the merger agreement could be terminated. This merger is a huge strategic move, and the uncertainty around it is a significant risk factor. Let's talk about the money. For the year ended the 31st of December 2025, CVB reported net earnings of $209.3 million. That is an increase of about 4.3% from the previous year. Diluted earnings per S-share were $1.52, which is up from $1.44 the year before. They're making more money, and it is costing them less to do business, which is generally a good sign. Non-interest income, which comes from things like trust and investment services, increased a little bit, but they also had some significant losses on the sale of investment securities, totaling $11 million, which definitely put a dent in their profits. On the positive side, they did make a profit of $2.3 million on other real estate owned. Looking at their balance sheet, total assets grew to $15.63 billion by the end of 2025. That is a healthy increase. Their loans also grew a bit, and their investment securities portfolio remained relatively stable. Deposits are the lifeblood of any bank, and CVB reported a decrease in non-interest bearing deposits. While this might seem concerning, they also saw an increase in their interest bearing deposits, so their total deposit base is still growing overall. It just means some customers are moving their money to higher yielding accounts, which isn't surprising given the interest rate environment. Now, about that allowance for credit losses, it decreased from $80.1 million to $77.2 million. This is partly because they had net recoveries, meaning they got more money back from bad loans than they wrote off as losses. But they are still forecasting a challenging economic environment with slower GDP growth and rising unemployment, so this reserve could be tested. When it comes to their investment portfolio, they have a large chunk in mortgage, backed securities, and CMOs, or real estate mortgage investment conduits. A significant portion of these are agency backed securities, meaning they have some government backing, but the report notes a substantial unrealized loss of almost $300 million in their available. For sale securities due to rising interest rates, this is a paper loss for now, but if they had to sell these securities, it would become a real loss. The good news is their non-performing assets are extremely low, only $4.8 million compared to over $15 billion in total assets. This is a very strong indicator of asset quality, an area where they are truly excelling. Scroll report of independent registered public accounting firm. And finally, their independent auditors, KPMG LLP, have signed off on their financials, stating that CVB maintained effective internal control over financial reporting. This is a crucial stamp of approval for investors. One specific area that KPMG highlighted as a critical audit matter was the assessment of their allowance for credit losses, particularly for their commercial real estate loans. This involves a high degree of judgment and complex calculations, so it makes sense auditors would focus on it. They have to make sophisticated models to predict losses based on economic forecasts and loan details. Circling back to that big merger with Heritage Commerce Corp, the deal is expected to close in the second quarter of 2026. If it goes through, CVB will become a much larger company with over $22 billion in assets and more than 80 offices. This is a game changer for them and represents a massive strategic move to expand their footprint and offerings. Now, looking at CVB Financial Corp, overall they seem to be navigating a complex financial landscape quite well. They are making more money year over year and their core banking operations appear solid with very low non-performing assets. The pending merger with Heritage is a huge opportunity for growth, but it also comes with significant risks and integration challenges that will need careful management. The unrealized losses on their investment securities portfolio are notable and something to watch, especially if interest rate volatility continues. Their high concentration of commercial real estate loans in California is also a point of consideration. However, their strong capital position and focus on core banking relationships suggest a resilient business. What do you think about CVB's performance and the upcoming merger? Share your thoughts in the comments below. If you found this breakdown helpful, give it a like and subscribe for more deep dives into the financial world. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next video.